Hey guys, Michael Silva here. You are watching Figuring Out Money. You see that right there? You see this?
It says to subscribe.
Hey, in today's episode, I'm gonna be talking about one of my favorite ways to invest, and that's with a target date fund. In this episode, I will be discussing 4 reasons as to why I believe target date funds are a great fund, especially if you're just getting started. Look, investing in the stock market can be very complicated. There's so many terms out there that can really bog you down. Diversification, asset allocation, index funds, mutual funds, tips, bonds, individual stocks, expense ratios.
I mean, the list goes on and on and on and on and on and on and on.
But let me put your mind at ease. A target date fund is a very simple fund that automatically diversifies your portfolio for you based on when you plan on retiring. Wow, that's pretty cool. Yes, it is cool. Let's hop into the 4 reasons as to why I believe everybody should just get started with that versus picking their own individual funds themselves. The first reason is asset allocation. Look, when I first got started with investing in the stock market, I and still honestly to this day don't know what the right asset allocation is for me specifically. I mean, you'll see a bunch of people on YouTube that just go into the S&P 500 and they just want dividend paying stocks, but they're only diversified really in the US market. What's so cool about target date funds is yes, it puts you in the domestic US market, but it also puts a portion to international funds, and then it also puts a portion into different bonds, both international and domestic as well. It's automatic, it's one fund, it allocates all of your resources, it's simple. Just to give you a quick example, here is my target date fund. It's through Vanguard. It is the Target Date 2050 fund. It has a good mix there of large cap, mid cap, it has small cap. These are from the US market. So it has a nice blend here. It is a heavily growth. It's kind of a blended of both. And then here's some of the sectors that it's automatically diversified within. And look, I only have $7,000 in this account. I believe that the minimum is $1,000 to start off with, but it automatically gets me some real estate, gets me in the technology sector, healthcare, energy, consumer defensive, consumer cyclical, communications. Like, this is so cool. And then the international regions, it has me in Europe, Pacific area or region, Canada. It has me in emerging markets. I mean, this is just overall I couldn't do this myself even if I tried. That's why I love target date funds, especially getting started. So let's just go ahead and hop back into the show. Reason number 2 is because of what's called a glide path. So these funds are based off when you plan on retiring, and a glide path, I'll pop it up right here on the screen. It shows in the middle here, it shows where your target date of retirement is supposed to be. And then as you notice at the very beginning of it, you're gonna have a larger portion in US and international stocks and a smaller portion in bonds. It's like a 90-10 ratio. But as you get closer to retire, this fund automatically adjusts based off your age and target date retirement to lower the risk that you can take. So it starts off as a high growth fund with a higher risk because you're younger, and then as you age, it makes it less and less and less riskier of a fund to be in. This is all done automatically based off the target date that you choose when you plan on retiring. It's so cool. Reason number 3 is the rebalancing. Look, if you don't know what rebalancing is, basically what it means is if you were 50% in domestic stocks and 50% in international stocks, but as the year goes, maybe domestic stocks really outperform your international stocks. You're no longer gonna be 50-50. You might be 60-40 or 70-30. What this does, the target date fund, it recognizes when there's overperformers and underperformers, and it automatically rebalances it to be in the proper set of asset allocation for you. Now, that's a big deal because a lot of people who pick their own funds do not rebalance. And when it comes to rebalancing, they don't know whether to sell a portion of it to buy another or just to stop funding it to add in and to add more into the other. The fourth reason is low expense ratios. Look it, I'm gonna put up a chart here to give you an idea. Now, a lot of people might think, 1% expense ratio is not that much. However, 1% of $1,000 would be $10. So imagine you have a $50,000 account, a $100,000 account, $1 million account, and you're constantly getting charged 1% every year to have it managed. That's ridiculous amount of money. So with the target date fund, my specific target date fund is through Vanguard. It's a 0.15 expense ratio. That's $1.50 for every $1,000. Like that is as low as it gets. I mean, unless if you want to manage everything yourself, pick out like that is so low to me. I absolutely love having low expense ratios. And there you guys have it. That is the 4 reasons why I personally choose a target date fund over allocating assets myself. Have a good day.